Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different aspect to investment and consider how the rules laid down by the father of the craft, Benjamin Graham, relate to modern day issues. In this episode, we shall look into the shorting of stocks, a strategy used by some to try and profit from a falling stock price. We will look at the different forms of short selling, consider the possible risks and rewards of such endeavours, and whether it is something that can ever be undertaken on value investment grounds. So as ever, pour yourself something caffeinated and get ready for another dose of Intelligent Investment Today. Before we get into the whys and wherefores of why some investors participate in the shorting of stocks, let's firstly nail down exactly what shorting a stock is all about and the different ways that it can be undertaken. Put simply, an investor will short a stock when they believe it is overvalued and that its price will fall in the short term. If they are correct, they will make money if the price of that stock does indeed fall. To short a stock or try to profit from the short-term falls that they have predicted, an investor has several options. Firstly, they can do so through the traditional route, which can be achieved through borrowing the shares of stock from an investment bank or financial institution. This is normally a service open exclusively to larger institutions rather than individual investors, although some brokers will offer this service to smaller investors. The traditional short selling route works as follows. Let's imagine that you borrow 100 Tesla shares through your broker. To do so, you'll pay the broker a fee for this service and also promise to return the shares at some point in the future. You will then sell the shares you've borrowed at the current market price of, let's say, $200, taking $20,000 from this sale. Let's now imagine the share price does indeed tumble, just as you'd predicted, to let's say $180. You would then be able to buy back all the stocks at the new lower price of $18,000. You would then be able to return the shares borrowed from your broker and close your position, netting a £2,000 profit, less the fee charged by the broker and repayment of any dividends the broker has missed out on as a result of borrowing you the shares. The flip side to the coin is, of course, that if things do not turn out quite as predicted and the stock rises, this means that in order to close your position, you would be obliged to repurchase the shares at a higher level than you sold them, in order to make good on the contract and return the shares to the lender. So you purchase Tesla stock at the same rate of $200 per share, but in this scenario, the stock price rises to $220. In order to close your position, you'd be forced to buy back Tesla stock at this higher rate and will be left with a $2,000 loss plus fees and dividend repayments. So it would seem on the surface that buying stock short is similar in scope to buying them long, but there is of course one very important distinction. Unlike purchasing stocks in the anticipation of price rises, by entering into a short contract, your losses are technically unlimited. For if you purchase a stock long, your losses are strictly limited to the total price you've paid for those shares. If you purchase $20,000 of Tesla stock and that business is wiped out tomorrow, then the most you can lose is that $20,000. However, by entering into a short position, you can be on the hook for an unlimited amount. For if you short $20,000 of stock and then that share price quadruples, you'll need to find $80,000 to close your position, so potential losses are effectively infinite. There are also some alternative ways to the traditional shorting of stocks that speculators can use to bet on a falling stock price. A popular alternative is through options trading. A speculator can purchase an option on a stock which gives them the right to sell a share at a predetermined price on or before the contract's expiry date. So let's say Tesla are trading again at $200 per share, and I wish to purchase an option on their stock. First, the issuer will want their pound of flesh. If they are to promise to buy my stocks for $200 throughout the duration of the contract period, they will demand a premium to the current price. This essentially acts as a fee for offering the service. So let's say the premium I pay here is $10 per share. And remember, options trading, unlike traditional short selling, have pre-agreed time limits, which are typically of short duration, ranging from weeks to months, or occasionally years. But let's say our Tesla contract option runs for 1 month. In this scenario, if Tesla's share price was to fall to $180 in that period, then I could exercise the right given by my option and make $20 per share profit, minus the $10 premium I paid, which works out as $10 per share net profit. The benefit of using options trading to profit from falling stock prices is, of course, that your maximum losses are limited to the premium or fee that you've paid for the option. If the share price doubles in value during the contract period, the most you'd lose is the premium you paid, in this case $10 per share. This way of trading also allows you to leverage your funds, as you're only paying the premium up front, which can greatly magnify gains. The disadvantage is that unlike traditional short selling, where usually the position is open-ended, option contracts typically run only for very short durations, so you have much less time for your predictions of doom to come to fruition prior to the contract expiration date. And if you require an option of longer duration, this can become very expensive indeed, with high premiums demanded by the issuer to cover the greater chance that your prophecy of a stock price collapse will come to pass during the period of the contract. In some countries, but notably not the USA, where it is, in my opinion, rightfully banned, speculators have a third option to short a stock. Spread betting and contracts for difference, or CFDs for short, offer the speculator the chance to bet on falling stock prices using what is in effect borrowed money. It works in a similar way to traditional short selling, but in this case you can never actually own the stocks you're speculating on, and it gives speculators the opportunity to leverage their investments. For instance, say we once again want to profit from a falling Tesla stock price, and we open a position to sell 100 share CFDs at $200, giving us a market exposure of $20,000. Because CFDs are leverage, we would only need to stump up a deposit to secure the position. So if the margin was 20%, this deposit would only be $4,000. If things worked out as planned and Tesla's stock price falls to $180, then we make a $2,000 profit. But because we've only had to wager $4,000 to achieve this result, rather than the full $20,000 through the traditional short selling route, rather than a 10% profit, we have a 50% profit on the capital employed. Naturally, the prospect of much bigger gains comes loaded with much higher risks. Leverage trading through spread betting and CFD contracts, as with the traditional form of short trading, leaves a speculator on the hook for unlimited losses. But further to this, they are amplifying the risks of total wipeout by risking money that isn't even theirs to begin with, meaning that they will potentially be left on the hook for this too. So those folks are your options should you wish to risk financial ruin. It will probably come as no surprise that as a value investor, I urge you not to attempt any of the above options. There are plenty of businesses out there that I feel are massively overvalued, and certain that it is only a matter of time before the general market reevaluates their attractiveness. But not on any one of them would I risk my financial future. Why anyone would speculate in a way that leaves them open to unlimited financial punishment is beyond my capabilities of understanding, especially when the option of backing the winning horse instead of the losing one and capping your losses can be every bit as financially rewarding. Clearly, if someone has already made up their mind and betting on the financial demise of some business or another is something they simply must do, then using options tradings to make this bet is perhaps the least worst route to take. This will at least put a lid on the potentially unlimited losses you could suffer with the other options on the table. But it must be remembered that the people costing up these premiums are not idiots. They will be pretty much the same people who choose the betting odds for horse racing or who will win the Super Bowl. They don't often get it wrong, and not many people will be able to beat them at their own game. So what if you reject my strong words of advice to leave short selling well alone, and you are somehow happy to live with the idea that one bad idea could risk your very financial existence? Will the rules of value investment, as laid down by Benjamin Graham, help you on your merry way to success in this endeavour? Well, of course, the basic ideas of being able to value a business and conclude whether or not it is over or undervalued may indeed prove useful. But as short sellers tend to be, by and large, in it for the short term, and as we know, in the short term, markets are very much a voting machine rather than a counting machine, then your superior ability to judge value may prove futile. It is indeed true that Graham did occasionally partake in the shorting of stocks, often as a part of complicated arbitrage positions, but in his subsequent writings warned people away from risking money in this way. It is also true that many of his disciples, including Warren Buffett, have warned against the unlimited financial losses inherent in this form of investment. In conclusion, I will say that money can be made from short selling, but it can also be made at the racetrack or at the casino. I suggest that if you're the sort of person prepared to take these inherently large risks on the roll of a dice, you'll have a much better time doing it with the latter two options, with the added bonus that at least with de facto gambling, your losses are limited. Further to this, quite simply, why would a value investor want to make money in this way anyway? They have been blessed to discover a way of investing that suits their character and temperament, an investment style that, if properly understood and executed, will in the long run make them rich. So why would they turn their back on the principles of patience and long-term outlook for what is essentially a get-rich-quick scheme? Any value investor taking part in short selling needs to take a very cold shower, dust off Graham's books, and reflect on what has gone wrong in their thinking. That is all I have for you today, folks. I do hope you've enjoyed the edition, and I hope that it makes anyone considering taking up short positions to at least think twice. We are all adults, so of course the risks you wish to take with your money are all your own, but all I ask is please don't do anything stupid. As ever, please do consider adding to playlist in order that you don't miss any future editions. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.